Good morning. Welcome to my biannual secular bull market update. We're going to look at we're going to do some secular cycle analysis today. Last time I did one of these was August. Before we get into it, I have to tell you everything we cover here today is of general investment advice nature. There's no specific or personal investment advice. Right, let's get into it. I do this, as I said, a couple of times a year, and we're doing what's called secular cycle analysis. It's big picture. There's an 17 to 18 year cycle that runs in the stock market. Now, it's not exactly on the dot to those years, and we'll look and see why that is not the case. And we'll do a little bit of technical analysis, long-term, monthly technical analysis of prices, mainly indices, and with a view to see where we are placed in this secular cycle at the moment. Now, I have to tell you that past performance is not a reliable indicator of future performance, but cycles and trends do exist. There is just mountains of proof of this, and they do persist longer and repeat more similarly than what most believe. And that is how technical analysts make profits out of the market, because of these trends and how they repeat, not exactly, but similarly enough. Now, the big question behind today's session is the secular cycle still up? So are we still in a secular bull market? And if we are there any early signs that may be hinting towards the end of the cycle coming and being pretty imminent? Because that's really the big question. And as I've told many of you who've been coming along to these sessions now I've been doing them for about 7, 8 years, we don't know that we're in a secular bear market until we're well into it. Secular bull market, much easier to pick from a technical analysis perspective. The secular bear, more difficult. But we'll come up with some signs today and have a look at them and see where we may be. So why is this big picture analysis? Why is the secular cycle so important for every investor? And the main answer to that, if I wanted to pick one answer, it's perspective. It's to get this big picture perspective. It's almost like seeing the whole procession of a march or a fair that's going through the streets of a big city with lots of bands and all sorts of things going on. That you sitting on the 50th story of a building somewhere and you see the whole thing from beginning to end. And but if you're in it, you're in the middle of it, and you're actually one of the participants, or you're watching as a spectator on the side somewhere in that procession, you don't really know what's gone. You don't remember what's gone, and you don't see what's coming either. So it's this bird's eye view, and to see where we are. That's really what this is all about. This perspective. And the thing is that this plays a major role in our belief systems about what you believe to be true about the stock market and how it moves. And having this perspective can make things a lot more simple. And what we can also do is see where we are in our stage of investing, whether we stage 1, 2, or 3 that Dave talks about so often. And majority of our clients and people who are interested in the market are, stage 2, stage 3 investors, where they might have a decade or 2 or 3 still to go. And some of our younger members, who are in their 20s and 30s have got 5, 6 decades to go. And you want to see where you are in that procession. So how does perspective affect you? It affects how you perceive, think, analyze, and make decisions on what to do. So it is very important indeed. And lack of perspective, and also having, which, and I think these are linked, a lack of perspective leads to dysfunctional habits, because you don't know where you are in this procession, and it leads to lack of consistency and lack of confidence in your decision making. And so that's what today is about, is to give you this big picture perspective. A little bit of terminology: secular bull, bear market, secular long term. It's used in some of the technical analysis textbooks that have been around for decades, but it's approximately a 17 to 18 year cycle. And as you'll see, it's not exact when we look back over the last 95 odd years, and or 100 years of data now. And then there's also a primary bull or bear market, which is a shorter term cycle within the secular bull or bear. And these typically last a half to 2 years cycles. And technically they are defined by the newspapers and brokers, and that is if the market's risen by 20%, it's a primary bull, and if it's fallen by 20%, it's a primary bear. But hey, you want to be taking some action before those happen. And also called a cyclical bear or bull, the primary bull or bear, you'll see that terminology as well. And then you have secondary bull or bear markets within the primary as well, and they're just shorter term cycles. And then you have this wall of worry, as I've always called it. Not my term, it's come from basically people who follow the stock market for decades and decades, where there's always bad news in the world. And whether it's geopolitical or something to do specifically with the stock market, you will never eradicate bad news. And that's what we call noise. And how the secular market cycles handle those is different. And so if you have bad news in a secular bear market, it has a bigger negative effect on prices. But if you have a negative noise or news in a secular bull market, it tends to shrug it off a lot quicker. And whereas as human beings, we tend to, depending on our walk in life, the way we handle bad news, we're very poor bad news noise handlers as a species. And this is where your analysis has got to come into the market, but even more so, how you perceive bad news, what decisions do you make, how do you handle bad news? That's really what this game is about, and that bad news can be seen as risk, if you want to call it that as well, which also turns into fears, and we end up just trying to play this game, just battling fears and risk and bad news all the time. But there's a way to overcome that, which I'll mention a bit later. So it's this ongoing secular market cycle versus ongoing 100% always there wall of worry noise. So big picture, and those of you that have seen these sessions before or watched some of the recordings on YouTube, this goes back to 1929. And for those of you that are new, that are seeing it for the first time, I'll just do a little bit more background. But I know that it's a really good thing for those of you that have seen it before to repeat it. So it just cements that picture in your head. So I'll make no bones about how good it is to repeat going through this. So effectively, I'm going to fill this chart with some, just to put it just to explain it as we go. But going back to 1929, you can see the 1929 crash bottom left there. And what these are is that was a secular bear market, so sideways to down. And one of the features of a secular bear market are these large, deep retracements, 60% over 5 years, lasted 20 years. And just note as well that the secular bear turns to a secular bull when the breakout occurs above previous highs. So, and the other trait of a secular bear is that it struggles to make new highs, new all-time highs. But when the breakout happens, off it goes. Here we have the secular bear market from up until 1982. That was 13.8 years. Where do we measure it from? From that peak. Now we don't know at that stage we're going into a secular bear, but here we have a minus 36%. That's a bear. So this is a primary bear market within secular bear markets. And there was another 49% fall there. 1.7 years. Look at the duration of these. That was a long one, 5 years. And that lasted 13.8 years until we had a breakout here in August of 1982, 13.8 years. And then we had the one that most people would be familiar with, which is the 2000 to 2013 secular bear market, and two primary bears there, 49.2 and 56.8, duration 2.5 and 1.5 years. And now we've been in secular bull market territory since April of 2013. Now let's look at the secular bull markets. Secular bull market starts when the breakout occurs. It doesn't start back here on the trough. We'll look at that in a moment. So to that peak, now we didn't know that peak, this much easier to pick. Don't know that peak until we've actually had a big retracement or some other signs that we're going to look at in a moment. 465% rise over 18 years. This was a real biggie, a 1,200% rise over 17.6 years from breakout to peak. And at the moment, we've had a 266% rise over 12 years. So let's look to see what the others did. So one point to make from there. So based on the length of the secular bear and the secular bull markets, we could have another 1.1 years to 8 years to run in the current secular bull market that we have. Sure, it's a wide window, but the sample that we've got to look back on, these are long-term cycles. So that's what we got. And so now I'm also going to come up with a secular analysis for a different way of looking at this market. But before we do that, let's look at where the previous secular bull market was when 12 years had passed by. That was a 354% rise over 12 years. So we're a little bit weaker than what that particular that rise was over 12 years. And the previous one was 181% rise. Now, it happened to hit the 12 years, just happened to hit the bottom of this trough, which was after a 28% decline in the market, which was a primary bear market within a secular bull market. We'll have a look at that in a moment. So outperforming that particular secular bull market, but underperforming this one. Now, there's another way, and this is the way that most people look at, most analysts and people that write about it, and this is why they tend to get it wrong, is they tend to measure the bull market, they call it a bull market, a primary bull market, not knowing that it's a secular bull market, and they measure it from the last trough. So this is March 2009 here, where that last trough formed. A lot of you probably remember it. And that's been going for 16.2 years now, and a 741% rise. And that takes into consideration the recent Trump tariff fall that we've had as well. So that's 16.2 years. Where point out as well, primary bear markets occur within secular bull markets. So the inflation bear of 2022, 25% fall over 282 days. Primary bear within a secular bull. COVID crash, primary bear within a secular bull, 33 days. Now, let's have a look at how long, if we measure rather than from the breakout, we measure from the trough over here of that. So we're in the trough of the secular bear, that trough. Now, what you'll notice is that it took a lot longer from that trough to make a new breakout over here to get into a secular bull. This was a much shorter one over here. Now, from trough to peak, 25.5 years, a quarter of a century with a 2,353% rise. The 1987 crash happened in the middle of that secular bull market. So primary bear markets occur within secular bull markets. This one going from the trough over here when we had a 60% decline over 5 years, took a lot longer to come out and break out, failed to penetrate there, came back into the range, breakout, 26.7 years, 1,300% rise. So here we are sitting, and that was the Kennedy slide. That was the 28% fall that the moment, remember the 12 years measures to that dip over there. And so you get primary bear markets within secular bull markets, but two big rises. Now using this secular analysis, so from last trough to peak at the end of the secular bull market, we could have 9.3 to 10.5 years left in this secular bull market cycle. So the 1.1 came from the shortest length of a secular bear market, which was 13.1 years, and we're 12 years into this. So that's where the 1.1 came from, the other analysis. And here, using this, if we go a quarter of a century or thereabouts, we could have 9.3 to 10.5 years left in the secular bull market. Now, which is it? I can't predict. I don't know. That's why we do this analysis. And what we're trying to do here is look for signs that could possibly be showing that that a secular bull could be ending or maybe imminent. So that's what we're going to have a look at a moment. We've got some indicators that we've been keeping an eye on. Before that, I also bring the presidential election cycle into this. That goes up to 2018. I'm still looking for some updated data. I could do it myself at some stage, but this is still good enough because it's an average. But what we're going to look at now, and I've noticed year 3 is always the biggest, but we're in year 1 now. Year 4 finished last year, obviously, and that's what we analyzed in the last secular bull market update that I did. So we're looking at this average of 9.3, but we know it's an average, so sometimes it's good and bad. So what kind of first years do we have in the presidential cycle? So far to date this year, which is the first year, we are minus 3.3 and minus 6.9 in 2025. The previous 3, you can have a look. First years of presidents, regardless of which they were, have been pretty good. But that was all in secular bull market cycle. The previous 3 were in secular bear market. The most notable one is the 2001, which was the first year of the secular bear market and the first year of a president, and we had minus 13 and minus 21% of that first year. 2005 was 3 and 1.4, definitely below the averages and not that good. 2009 was still secular bear market, but it had that, we hit that last trough in March of 2009. So that was the primary bull market that took us out of the secular bear market into a secular bull market. So that was a good year. So I'll do this in my summary later, but this could be, if we have a negative year in 2025 as the first year of a presidential cycle, it could be one of the signs that we are maybe moving into a secular bear market. So let's keep an eye on what happens in 2025 for this one bit. It's not the all and end all in deciding whether we are in a secular bear market or not, but it will certainly be one of the signs to keep an eye on. And there's lots of wall of worry stuff running around with the first year of Trump's presidency. So this is basically what I do, and you can do this yourself if you want to go back further. So this is the S&P 500 in 2021. Basically take the last day, 31st of the 12th, 2020, through to the 31st of the 12th, 2021, and you can see what the growth is in beyond charts. And you can go back beyond 2001 and have a look yourself. So this was 2021, 26.9, 27%, and 21.4% in the NASDAQ in 2021. In 2025, this year, so far, we're sitting on minus 3.3 on the S&P 500 and minus 6.9 on the NASDAQ. So we are 4 months into the year. One other way of looking at the S&P 500 is using the Schiller inflation adjusted. So he's gone, Robert Schiller's gone back and adjusted all this to 1870 odd. And the one thing you'll note is that the inflation adjusted is delayed. It lags the cash index of the S&P 500. So the 1950 secular bull market started when the Schiller inflation adjusted still had not had a breakout. It had a breakout there. This is when the 1982 secular bull market started, and the Schiller inflation adjusted S&P 500 was still falling when that happened. Eventually it broke out. And 2013 secular bull market started. Also, Schiller index, the inflation adjusted S&P 500 had started, but it took about 3.5 years before it actually had its breakout here to say, right, the inflation adjusted S&P 500 is up. So, and I show this because from a lot of people follow this, and it gets into the news, and brokers and everybody write about it and talk about it. And at the time when this 2013 occurred, and I wrote articles about it and spoke about it quite a lot, and those are published articles, is that people were using this index to say, no, this is not a new breakout to a new high, because the Schiller inflation adjusted S&P 500 had not made a new high yet. And of course, we saw it eventually did. So these people were three from April, so 3.3 years and 4 months off the 8 ball. Wall of worry, mentioned that. Well, there's still 2 wars going on, and there's a lot more being written in the newspapers, just the dailies, about other warmongering going on. So that's definitely one of the wall of worry variables to keep in the back of our mind. We know that when wars start, it's negative for the stock market, but the longer they last and the more they go on, the more desensitized stock markets become to wars, even world wars. Go back and look at the data. And effectively, there are industries that do very well out of wars. So it doesn't necessarily mean that that for a duration of a major war that the stock market's going to be in the doldrums for the whole of the war. We've got the Trump tariff turmoil. Looks like it's here to stay. And it's every day we don't know what's going to happen. Sometimes there's negative news, sometimes there's positive news on that. But it's certainly a variable that's is carrying a lot of weight at the moment and looks like it's going to for some time. Inflation and interest rates are still relatively high the world over. There are government interest rates, CPI figures that get put out. But those of you who've done the analysis in there will know that we all individually have our own CPI and our own interest rate, depending on where we are, what stage we are in our life, what products we consume, et cetera, et cetera. So they're still relatively high, leading to cost of living pressures, and depending on where you are, the cycle on your life, and what products you consume. There's also massive addition to government debts going on the world over. It's going to end at some stage, but we do know that it can persist and last, even for decades, with debt being very, very high relative to GDP around the world. And we've just seen the secular bull market has just shrugged off debt to GDP ratios around the world, and they all are on the increase. The Trump is having a go with Doge and Elon Musk to try and put a dent in that debt, or at least stop growing it. And you can see the massive resistance that happens. As a species, human beings become very used to being on the teat, and when you take the teat away, they grumble and complain and moan like there's no tomorrow. So it's going to be very difficult to reverse debt. It's just going to get bigger and bigger. The Magnificent Seven come to an end of the cycle. Has the AI trend stalled, or is it over, or is it going to have another leg up? We don't know. But the news, the noise around the large cap US stocks is far more negative than positive at the moment, and they're all trading well below their highs. And also our secular market cycles getting shorter. We've got the last, we had the 20-year back in the secular bear market back in the 20s, 30s, and 40s, or the 30s and 40s mainly, and then we had a 13.8 a secular bear market, and then we had a 13.1 year secular bear market. So are we going to have a short secular bull market as well? We don't know. And this, and people say that the speed and volume of negative noise that comes out is unbelievable these days with all the technology we have around. And there's this ongoing arm wrestle between negative noise coming out and speed of innovation to counter that, where there's positive news. And these are all variables that are weighing on the market all the time. And if we get caught up in this noise, we will just have no idea what to do. Confusion will reign. Inconsistency will reign. So we have to go to a basis for our decision making that we can trust in and believe in, and overcome this noise. Otherwise, we are just going to be in react mode to negative news all the time. So how does it affect this wall of worry noise affect unskilled traders? Well, it's we where most of the market declines. So when they happen, we are never there quick enough if we go by noise, and it gets us to knee-jerk react and make on-the-fly, inconsistent, erratic, and hesitant type decisions, and we experience drawdown in portfolios. And then when the market does start rising again, we don't re-engage because we're still fearful of the negative noise. And you know what? Even if that negative noise that caused a downturn to occur dissipates and the energy gets sucked out of it, there'll be a new bit of negative noise to come and stop us getting back into the market. And invariably what happens is people who are who ride the noise cycle and react to it all the time, they miss these uptrends because they've talked themselves out of re-engaging the market. It's subjective noise, and rather than having a steady process that you trust in and believe in. And they lack acceptance of these risks. They're not objective. They distrust the methods that they are aware of or use. They lack confidence in it, and hence also lack consistency and can't form any habits whatsoever that are functional with respect to making growth in the market. And their portfolios remain in drawdown. So it's an emotional response rather than an objective, consistent approach. And they're always chopping and changing and looking for new ways of analyzing the market that somehow are going to predict what's going to happen, because they're trying to remove this emotional hurt or this threat of losing money in the future. And so they just keep on moving from one bit of analysis to the next to try and get away from and analyze away these awful feelings that they get when the negative news hits and has an effect on their money. So we want to try and get out of that. And we want to, and rather than only looking to analysis to solve the problem, we do this big picture analysis, look at where things are, understand what the cycle is, and then we also get to go about developing habits, functional habits with respect to making profits in the market. So a summary of the secular analysis is if the S&P 500 replicates either of the two previous secular bull markets, remember they lasted 26 and 25 years, then we may be, and if we are 12 years into a 13 to 18 secular bull market cycle, by 2026, so the 1.1 years, if you like, on the very, very lower end to the 10.5 years at the other end, taking us into 2036, the S&P 500, if it replicates either of these, could go all the way to 8,800 and be a 460% rise from the breakout back in April 2013. So that's really looking at the first secular bull market and how at the rise that it had, or it could have 1,000% rise and replicate what happened in the second secular bull market, and that would take the S&P 500 to 20,500. Now, when I first put these numbers up, and the S&P 500 was like just over 2,000, 2,500, people were saying getting to 5,600 was just inconceivable by people. And in fact, we've been a little bit higher than 5,600. So the 8,800 now doesn't look that far off, but that's if it replicates. So this is not a prediction. It's just putting into perspective the opportunity that is available. And then a secular bear market starts, and that first leg down on the S&P 500 is going to be round about the 50% mark. On the NASDAQ in 2001, it was on the NASDAQ 100, it was 82% down. So we just want to avoid secular bear markets. But you're going to have potential falls between 10 and 35%. That's what the history shows us along the way, like the 1987 crash, the COVID crash, and the 2022 inflation bear market as well. So the investor's predicament is how to be optimistic about the current secular bull market we're in, but at the same time also risking a 35% fall, because that's what we can have in secular bull markets, or the secular bear market starting. So this hangs over our heads, and I've used this term before, like the sword of Damocles, these retracements within these primary bear markets that occur within secular bull markets, but also the start of the next secular bear market, because that's going to be the killer. Now, just to show you, there's some data, though it's of no secret to any of you that the flow of money, this is flows by quarter. This is in the United States over the last 2 years, 2.5 years. You can just see there's a steady increase into equity ETFs. So that's index ETFs. That's the SPY, the VOO, the IVV. These are all market or S&P 500 ETFs. The NASDAQ, the NDQ, the triple Q, NDQ here in Australia. There's just massive amounts of money flowing into ETFs. So this is the invest in the index and reinvest dividends, which is a brilliant, I've written a whole book on it. It's a brilliant strategy, provided you have time on your side. And so one of the things that you have to consider, depending on the stage that you're in your investing lifetime, is buying and holding index ETFs through a secular bear market, like I've just shown you. So the only two defenses that you've got, if that's your strategy at the moment, is to not sell. So to do not sell. So this is in green, do not sell, because it's obviously a positive thinking strategy. But you have to hold for around 13 to 20 years. and be genuinely, really and truly passive, i.e. do not sell. And the main defense there is to diversify into ETFs across asset classes. So you don't just go into equity index ETFs. You might look at bond ETFs and even some commodity ETFs, whatever it might be. But you have to come up with that strategy. Now, the other one is active investing with an exit signal, which is obviously what we do and what I did with SPA3 Trader which is our shorter term trading system, through the last secular bear market all the way from January 2001 to current. But an active strategy works brilliantly in a secular bear market. So that's the other way of doing it. It liberates you from this fear, the sword of Damocles hanging over your head all the time. And it eliminates the need to predict because your process takes you into cash. So those are the two defenses. Okay, now I'll come back to that in a moment. But before I do that, we're going to look at some market valuation ratios. So it's a little bit of fundamental analysis, if you like. We've looked at the obviously the technicals of the secular bull and bear market cycles and painted that picture. Let's have a look at some market valuation cycles. So one that people go to, and I'm not going to go through tons and tons, just one or two. And the one that people go to is called the Buffett ratio. It's the S&P 500 to GDP ratio. And you'll see every now and then people write about how high it is, approaching this 0.2 mark. So this data goes back to 1924. And you can go back further. If you go back further, you'll find out that the Buffett ratio was way up over here and much higher. But obviously, industry and things and technology have changed. So more recent data is probably more applicable. But I do put the 1929 in here just to put a little bit more perspective, big picture perspective on the current. Because everybody measures this and they're going to go back and they look the last 20, 25 years and they say, wow, look how high it is. So just a bit more big picture perspective. So these periods here are during secular bear markets. So you can see in secular bear markets, it obviously declines, and it does that because obviously the S&P 500 declines, and then it rises in secular bull markets because obviously the S&P 500 is rising. Now you can get this data on this long-term trends.net, and there's tons of other ratios you can look at there. But we are still, if you wanted to put a trend line on this, it is still rising. And I think the importance here is not so much the level it's at. It's more to do with the direction of it and to keep an eye on that. Okay, the next one to look at is the S&P 500 PE ratio. And the rule of 20 is what's been spoken about here for ages. And there's the rule of 20, the dotted line over there. And I question whether that is really an applicable rule in these days. So this goes back, here's 1990, and I think if you put an average through there, if you like, to come up with a rule of 20 replacement, it's probably closer to a rule of 25. So that's the all market P ratio. Everybody's talking about how high PEs are and they're overvalued. Well, just look at how long. If you followed that, then you wouldn't be in any. It wouldn't have been in any of the Magnificent Seven stocks at any stage. Because Netflix, I think, has run between 100 and 200 PE for years and years. So sure, it might retrace at some stage and might pull all the way back, down to a PE of 20, which would be a massive price decline, and it could still do that. I mean, anything can happen, but you miss out on years and years of potential profit to be made in nicely volatile, not highly volatile, nicely volatile, massive market capitalization stocks that trend very, very well. So that fundamental might need a bit of a rearrangement. But where we sit at the moment on the S&P 500 P ratio is, as of May 2025, is 28.2, which is obviously much higher than the 20, but more realistic if you think of 25 as being your rule to use in modern day. The Schiller P ratio, the cyclical adjusted P ratio. So this is his version of it. It's basically a 10-month rolling average on the P ratio, and that's sitting much higher at 35, and that's historic. And I'll put a bar through here, probably 22 and a half, maybe higher, looking at this historical, but more recent, it's probably more closer or or closer to the to what it should be, but still very high on that rolling 10-year average. And of course, he wrote the book about what is it, exuberance, irrational exuberance. And so this is sitting from a market valuation perspective relatively high at the moment. So and again, is this a wall of worry issue? At some stage, these valuations come back to roost, and we will see a retracement. There's no doubt, like we saw over here in 20, which was the bear market. So there we got the secular bear market. Look how this came. Why? Because the market, the actual price of the index fell considerably. So what do we have here? I think more importantly, during secular bull markets, we got rising cape. In secular bear markets, we got a falling cape. At the moment, we still have a rising cape. And from if you combine technical and fundamental, if you like, obviously this is mentioned. This is measuring PE ratios. Let's put a trend line on here and look for a serious break of this trend line rather than getting too carried away with the actual number that it's sitting at the moment. Looking at long-term interest rates, they are perceived to be relatively high, and there's a good case for that because since 2000 over here, most of the time over the last quarter of a century, the interest rates have been below the long-term average of around about 4.5. They've been way down over here. There's 2020 starts there, and so most of this time below here. So people are perceiving this with using their recency bias to be high at the moment, and they are relatively over the last quarter of a century, but over the very long term, they are not that high. But they've risen to here. Let's see what happens. They've basically risen to where the average is. Another indicator I'm going to look at, this is more on a positive side, and it could be seen as a fundamental indicator. And I looked at this a couple of years ago. Is the money on the sidelines? So the St. Louis, the Fed, which is the Fed, US Fed, and these indicators are all over. What this does is it measures the amount of money that are sitting in money market accounts, which is effectively measures money that's sitting in trading accounts, so people's trading accounts to trade the stock market, but it's not in the stock market, it's sitting in cash. And it's a measurement of money on the sidelines, either because people are feeling negative about the market or because they are, and potentially that money can come flooding into the market, or they're positive about the market and hence the cash falls. So let's go back to 1996. So this was the latter 4 years of the end of the previous secular bull market. So coming up to 2000, and you can see over here that this blue line rising from 400 billion, that is, to around about $1 trillion, that was money coming out of the market. So in the last 5 years, when the Nasdaq put on 500%, cash was coming out, and the amount of cash coming out, more than doubled in that period of time, and the market rose 100. That's the S&P 500 rose 165%. I think the Nasdaq was 480 odd percent, and pharmaceutical stocks were up 800% in that time. Money was coming out, so people could not stay with the trend. They were trying to preempt a fall in the market and missed out on that massive euphoric run up at the end where fortunes were made in the market. So you have to know when to hold and know when to fold, and that's going to happen at some stage coming towards the end of this secular bull market. When we get there, and I'll talk about it in a moment, one of the things you're going to be looking for is euphoria, and to signal that. And then we got to the secular bear market, the first primary bear in the secular bear market started, and of course cash came out. Market fell 49%. Sorry, cash was going in from there to there, and market fell 49%. And then we had a 60% rise in the market, and then a 30%, so a 90% rise. So cash was going in there and then started coming out over here. And then we had the second secular primary bear market within the secular bear market, and cash was coming out of there as well. And then when that ended, cash was running in. So this is the cycle coming out of 2009 that took us into the secular bull market. Cash was going in and the market rose 115%. And then we had this period of time where cash stayed on the sidelines, market rose 50%. And then cash leading up to 2020, market rose 40%. Cash was coming out again. They're trying to preempt. And then cash was going in and the market was going in over here and the market rose 45%. And here we get to this period over here, cash 10%. So that is in 2022. And the market fell 10%. Where are we now is we've had $1 trillion come out of the market, from $1 trillion to $2 trillion, $1 trillion to $2 trillion come out of the market while the market has risen 54%. So is this an early sign of what happened over here as well, with money coming out and then then the secular bear market actually starting here in 2000? Are we going to see this? I don't know. So over this from May 2022 to March 25, even though the market's risen 54%, we've had $1 trillion come out of the market. I'm not going to use that as a prediction and say, hey, secular bull market's come to an end, we're into a secular bear, but it's just one variable to bear in mind at this stage. Is this smart money coming out, or is this like dumb money that went on for 4 years over here? Well, time will tell. This quote I always put into these sessions is by Sir John Templeton. Bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria. Where are we on this? There's still a lot of skepticism around. I don't believe there's lots of optimism around, and there's definitely not euphoria. So is the optimism still to come? Have we still got another 10 years of this going on where the optimism eventually comes, because there's been just so much negativity thrown at the market and it continues to rise, and then euphoria happens, like from 1995 through to 2000? Well, we're definitely not in euphoria at the moment. So let's analyze this. So it's easy to determine the start of a secular bull market. It's difficult to determine the end of a secular bull market. That's the problem. And we're looking for objective signs to potentially alert the end. So I've put two to you so far. Keep an eye on the presidential cycle, and also the money coming out, the money on the sidelines. It's just grown so much. Is this smart money or is it dumb money? So let's look at some technicals now. I've started looking at the 14-month RSI on the S&P 500. So this goes back all the way back to 1928. And one of the things that's been found is that this 14-month RSI on the S&P 500, it drops below the bottom threshold, which is around about 30. So when we are leading into, so there's the secular bear market over there, and then it stayed above 30 and even got above 70 over here, and then got close over there, didn't, and then it dipped. So this was the first sign of a secular bear market starting in 1965 through to 1982. And you can see the RSI dipped below here a number of times. And then also on the secular bear market from 2000 to 2013, we can see that it dipped below here as well. So where is the 14-month RSI now as a potential early warning signal? So as at the 30th of May, because this is a monthly chart, it still has not dipped below. So it's not giving us an early warning sign. How early was it? Well, you can see it is pretty early over here in 1929-30. It was pretty early over here, the first instance of it, and even the second instance of in leading into the 65 secular bear market, and it was halfway down the first leg down of the secular bear market in 2000. So that was in 2000, but still early enough as an indication. No early sign yet in the RSI on the S&P 500. There's the Dow. The same analysis worked well on the Dow with all these indications over here below for a secular bear market periods. Not yet on the Dow has it dropped below the bottom threshold. So no early warning sign on the Dow with the 14-month RSI. And with the NASDAQ also similarly worked quite well. There was a false one back over here in when was that, 1990 thereabouts. But certainly in this secular bear over here, it gave indications. No sign yet on the Nasdaq Composite, and so using the RSI, we don't have any early warning signs yet. Looking at the COPPOCK indicator, this is one that you can see here in the secular bear period back here, 2000, spent a good chunk of time below and picked both of these down legs pretty well. So the COPPOCK indicator, it's a 14-month indicator, and so it did that pretty well. It picked the beginning of the secular bull here as well, back in that was a second leg up of the secular bull. So it's not too bad. And here where it gave a false signal, it was pretty short-lived. So here we had one in 2022, I think it was, and where we are at the moment, it basically corrected that and got back in the market. And now we still haven't had this drop below. So COPPOCK indicator is it's a very long-term technical indicator. 14 months is the period setting. It hasn't given a signal yet. Let's use a little bit of support and resistance. So here's the S&P 500. This was the 2022 inflation bear market, primary bear market, dropped 25.4%. And people here were saying, and then it had a breakout. And this is where we are at the moment. And I'll come back and look at this in a moment. Their support has been found. So it had the breakout, pretty big. This is the Trump tariff pullback. Had a pretty big fall and found support here at its previous all-time high. So we're looking technically at that. Just some in the last year, I decided to leave this on. When I did the last one, I put up some proof of these people saying things. Harry Dent predicted an 80% decline here in November 2021. Stan Druckenmiller, huge reputation, predicted stocks fat for 10 years, February 2022. So he was predicting this effectively a secular bear market. Hasn't happened. Why? Because you've had this breakout. And then Jeremy Grantham, he predicted a further 20 to 50% decline from there. So he was predicting it to come all the way down here in January 2023. Proven incorrect. Technically had a breakout, support found, and we've had from that 25% retracement to there, the market's risen to a couple of days ago by 57%. So technically, all of these predictions are incorrect, and technically the market is still rising. But what we've got to look out for now is what the market does when it gets to this high over here, which is just over 6,000. So now we're in no man's land. And so as a sign, if you like, to see whether the secular bull market can continue, and this is probably going to be the shortest term sign we're going to get, is what happens when the market gets back up to 6,000 here. Because secular bull markets break through previous all-time highs and continue the trend up. Secular bear markets fail at previous all-time highs and come back into the range and might test it again in the short term, but it could fall away. So in the next few months, that's going to be the first sign one way or the other, watching the support and resistance zones. So this is me just saying that, will the breakout to a new all-time high fail over here? So this is on the S&P 500, and you can watch the same on the Nasdaq 100 and also on the also on the Nasdaq Composite, and you can watch it on the DAX as well and on some other indices. So in the shorter term, I'll cover those once a month in the stock and the market updates that I do. So will the secular bull market will rise to new all-time highs? Secular bear markets fail at new all-time highs. So just keep an eye on that one. There's the Nasdaq. The Nasdaq, similar thing, breakout there, support there, and it had that it was a 36.4% retracement to there, and from that trough to current, a 74% rise. So that new all-time high over there was completed and confirmed by support being held at this stage. Of course, it could still fall below and come back into the range here, which would also be an early sign of weakness and potentially the start of a secular bear market. So this support and resistance will give us probably the first sign one way or the other. One last bit of technical to look at is the gold-to-equities ratio. So I've mentioned this before, but not pulled it apart in one of these sessions. And this could be used as a sign for the start of a secular bear market as well. Why would it potentially be the start of a secular bear market? Well, let's go back to 1978 here. And this here was this was in a secular bear market. Gold rose strongly. This blue line is the S&P 500. And where I've put these gold trend lines, trying to be a little bit cute, is where gold and equities are both rising together. Because there's people say interest rates rise, market falls. Gold rises, market falls. So the relationship between interest rates and equities is not as clear cut as people think. They do go in the same direction quite often. And as you'll see now, the correlation between gold and equities is not that clear cut either. They can both rise, and it's seen as a safe haven hedge against equities, but the equities also rise quite often while gold is rising. So let's just pull it apart over the last 40 years odd. So now we've got the secular bull market started here in August. That break above that red line in August of 1982. And you can see gold and equities. So gold is the blue line is the equities, and the red and green bars is gold. So when we had the secular bull market, notice what gold did. It went sideways to down for the whole time the secular bull market went on. So here we are at 2000. This is the top. At the time, we didn't know this was the end of the secular bull market, but that was that 1,300% rise in equities. Then we had a secular bear market. Notice what gold did in the secular bear market. Now, we only knew we were in a secular bear market probably around about here, but with the benefit of hindsight, this was the top. Gold started rising immediately. Now, we didn't know at the time that was rising because of a secular bear market, okay? We only got the benefit of hindsight here. But notice that equities rose in these two troughs up, while gold was rising during the secular bear market. So equities and gold can both rise at the same time. Now, we know now in April 2013 here, that was the end of the secular bear market. And I called that about 2 months ahead. I didn't call it was definitely going to happen, but I said, if this happens, then we're into a new secular bear market, and wrote an article in the ATAA journal at the time. And here we had gold starting to weaken, and the equities. So this could have been, with gold falling like that and continuing to fall, could have been an early sign as well of a secular bull market starting. And now what's happened is during this secular bull market, gold has risen, has fallen and gone sideways, but failed to make a new high while equities have been rising. And here's periods of time where they've gold and equities prices have risen at the same time. And now what we have is this breakout in gold. That is, I called it in one of I said, here's the breakout. This looks like a serious breakout. And, time to get into gold. Stocks haven't quite reacted the way that the gold price has, but they're starting to. But here we've had equities and gold rising at the same time. So what do we have here? Are we seeing this back here when the secular bear market started? Is this an early sign, or is gold going to retrace and equities continue, or they're both going to continue rising at the same time? Now, it's not clear from this, and I'm not calling a secular bear market having started because of this, but there is a lot of early money going into gold. And if gold does what it did here, where it went from 200 to 2,000, and we do end up in a secular bear market, I'll leave it for you to go from there. I'm not going to make any predictions, but that is particularly one early sign, and we have to keep an eye on it, because it could be something that leads to the next secular bear market. So where to from here? So some thresholds to be vigilant about. So breakout or failing at previous all-time highs. So and that's something in the short term we can get. Now, it doesn't have to fail once. It could fail and then try again and fail and try again, and eventually break through and continue the equities rise up, or it could fail straight away and drop back into the range. If that occurs, then there is some serious questions to be asked about this secular bull market continuing. And look at the support levels of the S&P 500 and NASDAQ as well for both of those. Understand that 20 to 35% declines in the last S&P 500 now was 18% with the Trump tariff turmoil. Back in in the inflation bear of 2022, that was a 25% fall. So between 20 and 35% declines are okay for a secular bull market. It's when they go deeper that it's not okay. So when you get to minus 40, the Nasdaq I think got to a 37% fall in 2022, but that's not okay. And if these are reached, then it's a high probability the fall will continue. The market will, the sellers will get into control, and we need to look to see where, if that happens, where it is in the secular cycles that we just analyzed at the moment. So if it reaches, if it gets to 40 to 45%, the odds are it's going to go 50% plus or minus 50% plus down. And, we know the NASDAQ 100 had an 82% decline in 2001. So it's very likely that the first leg down of a secular bear market is going to hit those sorts of levels. When you look at the elevated P ratios and the massive rises that we've had and the market cap of some of the tech stocks, it's pretty possible that's going to happen again. Keep an eye on the 14-month RSI. It's plotted monthly, and you can see that it doesn't, you don't have to do intra-month stuff. A monthly chart is okay. And let's keep an eye on the presidential cycle as well, for a negative first year. If it's going to come out a negative first year and get to be in secular bull market type returns that we've had in first year of the presidential cycle, then it's got to get to over 20% from here. To repeat what it's done in the secular bull market so far, that would be a pretty good year for the rest of the year. So the longer the year goes on, and the more the market stays volatile at these negative levels since the beginning of the year, the more difficult it's going to be to get into positive territory and decent positive territory to get anywhere near the average of first year presidential cycle. And the other one is to keep an eye is on human emotion. The end of a secular bull market typically ends with massive euphoria and massive rises in prices that just people do not believe. And if we sit here now and say, well, I can't see that happening, well, just remember that anything can happen. And that's one of the tenets that we use, one of the principles we use that comes from Mark Douglas's 5 fundamental truths. If you don't believe anything can happen, then you must know what's going to happen effectively, and you've got some insight into the future that you're going to make decisions based on, which is your beliefs and also this perspective that I mentioned at the beginning of the session. So nobody can predict the future. It's pure folly. People who predict to protect, to prove, and who distrust, fear, and hesitate, all of that is ego-driven. We've got to get our habits out of our ego to be successful in the market. We've got to build functional habits that are not ego-driven. They're process-driven based on fact and probability and numbers, rather than our emotional ego, which is just trying to predict, protect, and prove. So, do you succumb to noise? Do you continue changing your criteria all the time to predict? If this is what you do, you have to change that, right? You can't just continue changing your criteria all the time to try and remove what you don't like about the market, because there's going to be more to dislike in the market in terms of negative news that you'll find in any other walk of life. So if you're just trying to remove the threat of hurt, the threat of emotional pain, you'll never be consistent, and you'll never build functional habits that will see you become habitually profitable in the market. So you have to prepare a plan for whatever happens. Anything can happen, and then you have to trust that plan. So a great quote I always put in these presentations by Dennis Waitley: expect the best, plan for the worst, and prepare to be surprised in both directions, up or down. But your plan must be able to plan for the worst and handle those situations. Is your plan buy and hold ETFs? Well, then your plan has to be to never sell, and to continue reinvesting the dividends depending where you are in your cycle of investing. So preparing for the worst, which is a secular bear. The best strategies for a secular bear market, which is really the worst to expect and to plan for in the market, is you don't want to be a buy and hold of index ETFs or buy and hold stocks or balanced funds and target date funds or target date funds, or you don't want to be discretionary or intuitive or subjective. You want to have a plan and a process that because your intuition is just going to be your beliefs and your habits, your dysfunctional habits coming to the fore. That's all it's going to be, unless you are genuinely and really and truly passive, and you're never going to sell. then buy and hold index ETFs can be your strategy. But if you're at the latter end of your investing years, that might not be a good way to go. Why? Because as I've shown you, in secular bear markets, there's no growth for 12 to 13 years, only dividends. And you have to live through 45 to 80% declines, make that 49% to, I think 46 was the smallest one, the shallowest one, to 82% declines. And at least 2 of those happen in every secular bear market. So how do you prepare for a secular bear? Well, you must avoid most of each primary bear market. That's what you've got to do. If you've got a process that avoids most of the primary bear markets, the 50 to 80% falls during the secular bear, then that's good. Then you minimize your exposure through objective and consistent timing, which is the way that I do it and that our customers do it. And you can make the most of primary bull markets because the Nasdaq went up 150% on the first rise after that first fall in 2001-2 and to March 2003. The next rise from March 2003 over about a year and a half was 150%, and the All Ords did 150% in that rise as well. So you want to maximize exposure in the primary bull markets. Warren Buffett quote that he made, I think, back in the late 50s: in a year when the general market had a substantial advance, I would be well satisfied to match the advance of the averages. And basically, he goes on to say to not go down by as much in the falling market. So this is what you want to do. You want to be out for most of that. I haven't got those red down arrows going from the peak to the trough. You're going to get out after the decline starts, and you're going to get back in after the uprun rises from the trough. So you want to be in for most of the green and out for most of the red is effectively what you want to do. You don't need to be perfect. And you want to start an active timing. So you're either going to be buy and hold and never sell index ETFs through the entire time, or you want to start an active timing approach after the secular bull market starts. If you do that, it'll be too late. You want to be prepared before the secular bear market comes. Why? Because it takes 6 to 12 months to acquire the habits and the processes and the systems necessary to be successful through a secular bear market as an active investor. So that's what you really should be thinking about. Right, to finish up, this is most of the people on this call will be existing customers and we've got a few hundred now, approaching 300 of our customers have gone through the Learn to Trade Properly study groups that we do. And so this is a call to our existing customers who haven't gone through that to get onto one. There's another one that starts on the 2nd of June. And the feedback we're getting from our existing customers and new customers alike on this Learn to Trade Properly study group we do, where we do live trading, tangible, hands-on in the market. And we really do teach you to trade properly, learn to trade properly. Where does that come from? It's a Mark Douglas term, and he defines what trading properly is, and we do that in the course material. So if you're a member or an ex-member and you haven't done this yet, you can email the Sharewell Systems help desk on support@sharewellsystems.com and just say you want to be on the 2nd of June one, and the next one will start a couple of months after that, the first week of August. And for non-members, if you want to book a call and I'll take you through and explain what it is, then go to learntotradeproperly.com and you can either join up the Learn to Trade Properly study groups from this page, or you can book a call and get some time in my diary and I'll take you through explaining what it does. But the feedback we've had from people who have gone through this is absolutely phenomenal. So to summarize, secular bull markets make all-time highs, bears don't. Watch what happens in the S&P 500 and the NASDAQ in the coming weeks, and you'll probably know within probably 2 or 3 months, I would say, as to whether that new all-time high has been breached and a breakout's occurred or not. And so I can tell you now, the current secular bull market is still intact. There are no signs anywhere that are strong enough to say it's not. And expect, as I said, 10% to 35% falls during the secular bull market, but you don't want more than that. And anything can happen. The secular bear market could end this year or go all the way through to 2036, but we'll be watching it in these sessions over the coming years. And fundamental truth number 2 from Mark Douglas is you do not need to know what will happen next in order to make money in the market. And that's one of the things. Why? You're thinking, wow, how? Well, that's what we cover in depth in our Learn to Trade Properly study groups. Be prepared with an appropriate investment plan. Understand the big picture of the secular market cycles like I've gone through over here. You can watch the recording of this. It'll be out on YouTube later today or tomorrow. Keep this 1930 to 2025 big picture perspective in your mind's eye. Get perspective. It should be an overriding background that sits in the back of your mind. It's a theme to your investing, if you like. And whether you accept today's analysis or not is not the major issue, because I'm sure some of this that those of you watching would have clashed with your current belief systems. That's fine. But if you don't have the perspective that I've shown you, you'll have some perspective. You won't have zero perspective. Your belief system needs to have a world view of the markets. And that's the one that you're going to be operating out of. So even if whatever perspective that is, you need to ask yourself, is that helping or harming my active investing? Whatever you believe it is, you need to put together an investment plan to execute within the bounds of whatever that perspective is that you have. So I commend the session to you. If you want to take advantage of the opportunity stream that the market has, especially during secular bear markets, so be out most of the time in the primary bear and in for most of the time in the primary bull within a secular bear market, then you have to overcome the wall of worry noise. You really do have to do that. You have to build new habits. You have to build functional habits and overcome and de-energize the dysfunctional habits that you have with respect to investing in the market. And I'll put to you the steps to consistency, and we cover this in detail in our training. Is the first step is acceptance of all the risks. If you don't accept the risks, then you are always going to be trying to avoid whatever it is that you perceive that's going to emotionally hurt you from the stock market. Basically losing, being wrong, missing out on profits or missing out on trades. And you are going to try and anticipate and predict all the time. And you are going to try and solve that purely through analysis. And it's unsolvable purely by analysis. You have to build objectivity into your trading routines, into your habits, which you can only trust objectivity. You can't trust subjectivity because it's changing all the time. And you can only build confidence in something you trust, which doesn't change all the time. And the only way you can become consistent is to be confident in something that is objective. You can't become consistent with subjective decision-making rules that you have, or can't even call it. It's a rule subjective if it changes all the time. It's not a rule if it keeps changing. So you'll never be consistent if you don't build an objectivity into your trading regime. Use a mechanical system, solves all these problems. It's the only way, as per Mark Douglas. If you resist using a mechanical system, then go to your ego, because your ego is trying to prove something that is unprovable, that you will be able to, without the necessary training and maybe decades in the market, trying to prove that you can do it on your own volition and discretion, which you'd fit into the 0.0001% of traders on the planet if you believe you can do that. So dig deep and take a look at your ego if that's what you're thinking right now. And we have our Learn to Trade Properly study groups is the solution to this. So I'll end there, and I'll take questions if anybody has at this stage. Most people don't ask questions these days. Don's just saying, excellent presentation, Gary. Thank you. We'll do the monthly updates, certainly. Steve has asked, do bear markets in different countries historically always end on euphoria? The other one that I have the most belief in, if you like, is the DAX. That certainly does show those traits, and so does the Australian market as well. Nick saying, I've read about the S&P 500 gold ratio. The last time gold made an enduring peak in 2011, around $1,900, it roughly coincided with the ratio of the metal in ounces divided by the S&P 500 at about 1.5 times. Now it's only about 0.64 times. So does that mean 9,000 gold when S&P 500 goes to 6,000? But USA going to... So that ratio you're talking about, the 1.5, you can actually plot that, Nick. I won't do it now, but you can go back and plot equities versus... and you can also plot, you can also look at other currencies as well. But that 1.5 doesn't hold all the time. It moves about. But you can certainly plot that. But nothing means anything in the stock market. You can't predict 100% certainly based on what's gone on in the past. You can only follow the trends that are happening. So trend is your friend. It starts and it ends. You don't have to try and pick it at the very bottom or get out at the very top. If you get a chunk of trends along the way, regardless of what all these ratios are saying, you just look at the price action, and the price action becomes your language. It's what speaks to you to tell you what to do. And that's what you got to listen to, is the price action of the market. And it also overcomes the wall of worry noise. Rather listen to the market than listen to opinions and innuendo that comes from the outside, which is all moved by people's journeys to wherever they are at that time, and the threats and the fears that they have of the market. That's all that opinions come from. So you got to listen to the opinion of the market, and the opinion of the market, the language of the market, is price action. Okay, so John is saying, I do not trade. Do I need to do the course? Yes. Well, I'd say if you don't trade, you don't need to do it. But in the Learn to Trade Properly, it's live market. What we do is people start with various amounts of money. We ask that people pick an amount that's not too much, that it's going to take you out of the process. So it's not going to be too emotionally painful if you have a lost trade, but it's got to be enough to have some skin in the game to actually test your current dysfunctional habits and to turn them into functional habits. So it's a small amount of money. It mustn't be a lot, but it mustn't be so small that it doesn't mean something. And it's live trading. So everybody trades, the whole group trades exactly the same portfolios, and that way we can be accountable to measuring how you're doing. It's a very detailed course, and you need to be doing it for. They say it takes 60 to 66 days. The scientists say to change a habit from dysfunctional to functional with respect to the environment that you're operating in and what you're trying to achieve. So this is not something you can just read and do. We're dealing with money here, and people get highly emotional about their money. So we are overcoming some deep-seated dysfunctional habits that need to be changed and to become functional. So you need to be in one of these for at least 3 months. Now that doesn't mean, what does it mean? It means that you do an hour webinar a week, and you do some homework that you get given to go through the study group. And you run a closed forum where you can ask questions and discuss how you're going through it. But you're also live trading. So we don't know when the trades are going to come up. The market dictates that. And that's the vigilance and the process and the habits get built through the market helping us to build those habits with the aid of a mechanical system. Okay. Bruce is asking, was there a hiccup in the apps alert last night? Yes, I believe there was. And I think that was being fixed just before I came on air. Pleasure, James. Thanks very much for the feedback, everybody. I'll end it there. And of course, you can always ask questions on forums or directly of us. But I commend the presentation to you. We'll be back and do another one of these before the end of the year to see how it's played out. And as we near that end of the year, and we might look at support and resistance, see what's happening with gold, see what's happening with the presidential cycle. There'll be a whole bunch of things to come back and look at and see if we're any closer to a secular bear market or not. I'll end there. And as always, I wish you consistent, objective, and peaceful, active investing.